Sandip Agarwal, fund manager and co-founder of Sowilo Investment Managers, joins us right now on the show. Sandeep, difficult times if you are a bull and an investor, particularly at the broader end of the spectrum, right? I mean, what are you guys doing? I mean, are you putting in more money to work? What's the sense about how much further would this pain continue?
So, it is good afternoon and thanks for having me on the show. It is very difficult to call the bottom of the market or how long the pain will be, but the best way always has been, and this is what we have been doing for a long, long time now, is that we have to evaluate stock specific way every company. And I generally don't believe so much on mid cap, small cap categorization of the stocks for calling the bottom. Rather, we believe in bottom up approach. Every company has its own unique business model, and we have to see where that business model is in the cycle and whether the risk reward is favorable. So I think that yes, the times are difficult. People have made an insane amount of money, and now there is some reversion to mean, and we have to deal with it.
But Sandeep, this is Harsh also joining in. Generally, when you have a market breadth which is this weak, you largely start to see all stocks get impacted, regardless of whether there is value in it or not. And therefore, is this causing a little bit of excitement in your office? And are you looking at certain names, therefore, names, sectors, that's really piquing your interest at this point? Because if it was a little bit or a tad bit expensive, if that's what you were buying 2 months back, now you're buying it at a real sale.
So we were a little cautious some time back, and we were not buying any expensive stocks. Now with the current correction, few of those sectors and stocks have become quite attractive, and particularly power ancillaries, manufacturing, where water theme, where stocks were insanely priced. I think there is 30-40 percent correction which has happened, and we expect little more correction to happen there. And we will keep on accumulating on the way down.
Okay. Sandeep, okay, power ancillaries, I'm going to just probe some of these things, right? Because when, as our wife says, bears are on a hunt, it offers very good prices. So on power ancillaries, what's the rationale, and what within power ancillaries? Is it transformers? Is it grid companies? Is it something else?
Transformers, cables, they are looking really attractive. And
sorry, come again, Sandeep, I didn't hear you.
Transformers and cable companies are really the ones to look at because they are the best proxy to play power. But we are not buying the expensive ones. We are buying where there is real value. Also, we do like the companies like NTPC because there is consistent income, long term is there. So we are quite constructive on those names.
Okay, viewers, remember, this is just, please do your own due diligence. Sandeep is using this as examples to talk about things. So, Sandeep, I hear you when you say power cables. I want to expand that a bit further and just sticking with energy for a bit longer. The talk of town was green energy, right? And energy transition. And some of those companies have given very good results, by the way. The commentary also looks solid. The multiples have contracted. Have they contracted enough for you to relook those pockets even if you don't buy them? Or do you believe the valuations are still very expensive?
So generally we avoid sectors which are most talked, and I think solar is one of them. So we are not very bullish. We like the sector, we like the companies, but we honestly don't want to get into them right now because we still believe they are pricing in too much positives, and we would be avoiding. It is actually a sector which we are not very actively looking at right now.
And while we're talking power, Sandeep, the interesting piece is power financiers. They've come off sharply from the highs. They were trading at closer to 2 times book. They're currently sitting anything between 1.3 to 1.5. And among the significant ones, there are 2, which is REC, PFC. They've seen sizable correction. Recoveries continue to come through, but they are suggesting recoveries will taper by calendar year end 2025. But they're saying that the growth and the demand will ensure that profits will sustain? One, and two questions here. One, is this at all on your radar? And point number two, do you believe that profitability for some of these companies can sustain, or do you believe that you'll see a taper given that recoveries will also start to wane? Any asset quality issues that you see here?
So, as you rightly mentioned, they have corrected quite a bit and they have come off, and the future doesn't look bad at all. But we will play better proxies to them also. So, we are very actively looking at private banks which are reasonably priced and where we believe the worst is behind. And those names are actually better proxy, and we would prefer them over power finances.
Sandip, we spoke power. And I want to try and shift focus on consumption now. How are you playing that theme? And how are you looking at it? With what lens? Are you at all constructive, or what's the view?
So, consumer, as you see, it has corrected a lot, and also there has been a good reward in the budget, in the sense that till 12 lakh there is no tax. So obviously all these things trigger and help consumption, but we still don't know how much more damage quick commerce is going to do. And we have seen that consumer has not done well for quite some time. It has underperformed. So time correction has been happened, but we still don't know how much of PE rating can happen. The sector seems to be safe in this turbulent market. But finally, in long-term stocks do perform based on their earnings visibility and growth. So I think from that perspective, still there is little more time before we start looking at them in terms of accumulation.
Okay. And Sandeep, the other small question would be, I don't know how closely you track that space, of course, but chemicals, they promised a lot this quarter. At least everybody was hopeful, and the numbers have been very, very weak. Now, the question only is this, that it's not that the cycle had turned. People were just expecting it to turn. Maybe it turns the next quarter. What have you gauged from the con calls and from the reportage that has happened thus far?
So as Neeraj, you rightly mentioned, no one was expecting a turnaround, but bottoming out was called out. But the way, after Trump taking over and the way tariff war has started, the challenge which we are facing is that China will have to dump its production. And that is the worry today everyone has in mind. No one is worried about, otherwise on the demand, but the dumping which can happen and how it will get routed through different countries is something which everyone is worried. So I think, that is the cause of the worry. That is the cause of the reaction which you are seeing.
You reckon that, therefore, the pain in chemicals will continue, Sandeep?
I will not say that it has ended.
Neeraj wanted to touch upon CDMO as a space, as a pocket. Is it looking good to you? And what could be some of the ancillaries within the supply chain which may actually benefit from a push with regard to CDMO if it were to come?
So, if you see globally from India's perspective, software, pharma, software and auto are spaces where we always had strength. And I think to that extent, we always are able to find out innovative ways to make a mark there. So I am quite constructive on this space, honestly. And we believe that CDMO has a long way to go. And we are very, very constructive on the space. Only thing is that, we don't know when the actual numbers will start coming in. So it is a invest and wait kind of thesis. So when that is the thesis, then you slowly build up your position. So that is the way we are looking at the space.
Okay. Thanks so much, Sandip, for joining us, for all of that perspective. Always a pleasure speaking with you.